Silver's biggest move of 2026 may be days away. Watch this before June 18th. Something is building in the silver market right now that most people are completely ignoring. And I don't mean a small technical bounce. I mean a structural move. The kind that happens maybe once or twice in a decade. And the setup is pointing directly at the next few days. June 18th. Mark that date. Because by the end of this video, you're going to understand why that date matters. What's quietly building beneath the surface of this market. And why the investors who see this coming are positioning right now, while everyone else is still distracted. Stay with me. This one is important. Here's what most investors get wrong about silver. They think of it as a poor man's gold, a secondary metal, something you buy when you can't afford the real thing. That's a mistake that has cost ordinary investors enormously over the years. Because silver is not just a monetary metal. It's an industrial metal. It's a technology metal. And right now, in mid-2026, it sits at the center of three of the most powerful forces in the global economy simultaneously. Monetary debasement, industrial supercycle demand, and a structural supply deficit that is getting worse, not better, with every passing quarter. When all three of these forces converge at the same time, silver doesn't move slowly, it moves violently. And the technical setup we're seeing heading into June 18th suggests that moment may be closer than anyone in mainstream finance is willing to admit. By the end of this video, you're going to understand the macro case, the supply and demand reality, what's happening at the COMEX, and why the next few days in the silver market could be the most significant in years. Let's go. Section 1. The macro backdrop. To understand what's happening in silver right now, you need to understand the world it exists in. And the world it exists in right now is unlike anything we've seen in modern financial history. Start with debt. The United States is now carrying over $36 trillion in national debt. The interest payments alone are running close to $1 trillion per year. Think about that for a moment. $1 trillion every year just to service existing debt. Not to build anything, not to invest in anything, just to keep the lights on for debt that already exists. That number is not going down, it's accelerating. And here's what that means in plain language. When a government is drowning in debt and needs to fund itself, it has limited options. It can raise taxes, politically dangerous. It can cut spending, also politically dangerous. Or it can find ways to inflate the debt away, to make the currency worth less over time so the debt burden becomes more manageable in real terms. That third option has been the default playbook of governments throughout history, every single time. And what happens to hard assets? Real, physical, finite assets, when the currency they're priced in gets debased? They go up. They go up because the currency is going down. They go up because people flee paper for something real. They go up because the math of monetary debasement is ruthless and inescapable. Gold figured this out first. Gold has been making new all-time highs throughout 2026. And historically, every single time gold makes a sustained move, silver follows. Not immediately, not politely. Silver lags, then it catches up violently. That catch-up trade may be building right now. Section 2. The Federal Reserve Trap. Now here's where it gets complicated. And this is the part most retail investors completely miss. The Federal Reserve is trapped. On one side, inflation is still running hotter than the Fed's 2% target. They know that cutting rates aggressively risks reigniting an inflation spiral that destroys their remaining credibility. On the other side, the US economy is showing real signs of stress. Credit card delinquencies are rising, commercial real estate is still bleeding. The consumer, who has been the engine of this economy for years, is starting to crack under the weight of high interest rates and persistent inflation. So what does the Fed do? If they cut rates, they admit defeat on inflation and risk sending the dollar lower. A weaker dollar is rocket fuel for silver. If they hold rates, they risk cracking the economy further and eventually being forced into emergency cuts anyway, which, again, is rocket fuel for silver. And if they somehow raise rates in this environment, that would trigger the kind of bond market stress that forces the government to monetize even more debt, which, you guessed it, is also rocket fuel for silver. The Fed has built itself a trap, and silver is positioned on the other side of every exit. Smart investors understand this asymmetry. They're not betting on one specific Fed action. They're betting on the fact that every possible Fed action in the current environment leads to the same place. That's not speculation. That's just following the logic where it leads. Section 3. The supply deficit nobody talks about. Now let's talk about the part of this story that the mainstream financial media almost never covers. The physical silver market has been running a structural deficit for years, not a temporary imbalance, not a short-term squeeze, a structural, multi-year deficit where the world is consuming more silver than it is mining every single year. Here's why. Silver demand in 2026 is coming from directions that didn't even exist a decade ago. Solar panels. Every single photovoltaic solar panel manufactured in the world today requires silver. Silver is used in the conductive paste that allows solar cells to capture and transmit energy efficiently, and the solar industry is not slowing down. Governments around the world have committed to renewable energy targets that require massive solar build-outs for decades to come. The numbers are staggering. The solar industry alone is now consuming hundreds of millions of ounces of silver per year, and the demand curve for solar is still pointing aggressively upward. Then there's the EV revolution. Electric vehicles use significantly more silver than traditional combustion engine cars. Silver is in the batteries. Silver is in the circuit boards. Silver is in the charging infrastructure. Then there's AI infrastructure. Data centers, the physical buildings that power artificial intelligence, require enormous amounts of silver in their electrical systems and components. The AI build-out we're seeing in 2026 is creating silver demand that didn't exist even 2 years ago. And then, the traditional demand drivers that never went away: industrial manufacturing, medical applications, water purification, defense electronics, photography, all still consuming silver at significant rates. Now put all of that together and ask a simple question. Where is all this silver coming from? The answer is uncomfortable. Silver mine supply has been essentially flat for years. There are no major new silver mines coming online that will dramatically change the supply picture. Silver is predominantly mined as a byproduct of other metals, copper, zinc, lead, which means supply can't simply respond to price signals the way a primary mining operation might. You can't just decide to mine more silver. The metal comes out of the ground when other things are being mined. That's a supply chain the market has very limited control over. The result of all of this is a deficit, a real physical deficit. And deficits have a way of eventually finding their resolution, through price. Section 4. The COMEX reality. Now I want to talk about something that I think is genuinely important to understand, and it's something that makes the silver market unlike almost any other market in the world. The COMEX, the primary futures exchange where silver is priced, operates on a system where paper contracts vastly outnumber the physical silver that actually exists in the vaults. Let me explain what that means in practical terms. When you buy a silver futures contract on the COMEX, you're not typically buying physical silver. You're buying a paper promise, a contract that says you have the right to silver at a certain price on a certain date. Most of these contracts are never settled in physical metal. They're cash settled, rolled forward, or closed out before delivery. This creates a situation where the paper price of silver can diverge, sometimes significantly, from what the physical market is actually doing. And it means that a relatively small amount of actual physical buying pressure, real demand for real metal, can have an outsized impact on price when it collides with a market that has been pricing silver based on paper dynamics. Watch what's happening in the physical market. Watch the premiums on physical silver coins and bars. When premiums start rising, when people are paying significantly above spot price for real metal, that's a signal that the paper price is not reflecting reality. That divergence eventually corrects. And when it corrects fast. Section 5. The gold-silver ratio. There's one more metric I want you to understand before we get to the setup heading into June 18th. The gold-silver ratio. This is simply the number of ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is historically elevated, meaning silver, relative to gold, is cheap. Historically, throughout thousands of years of monetary history, the average gold-silver ratio has been somewhere around 50 to 1. In nature, silver is approximately 17 times more abundant than gold. The market has historically priced this relationship, with some variation. When the ratio gets to 80, 90, or above, as it has been in recent periods, history says silver is dramatically undervalued relative to gold. And here's the key insight. When the ratio mean reverts, when silver moves back into historical alignment with gold, the move in silver is dramatically larger in percentage terms than the move in gold, because silver is starting from a lower base and covering a larger percentage distance. If gold is at $3,000 and the ratio is 90 to 1, silver is at about $33. If the ratio moves back to just 60 to 1, still historically elevated, not even back to the average, silver goes to $50. That's a 50% move in silver while gold stays flat. Now imagine that ratio compression happening while gold itself is also moving higher. The math gets interesting very quickly. Section 6. The setup heading into June 18th. So why June 18th specifically? What makes the next few days significant? Several things are converging. The Federal Reserve's next policy signals, the options expiration cycle on precious metals derivatives, the end of a quarterly positioning period for institutional money managers, and a technical setup in silver that has historically preceded significant moves. I want to be precise here. This is not a guarantee. Markets are never guarantees. Anyone who tells you they know exactly what silver will do on any specific date is selling you something. What I'm saying is that the conditions, the macro backdrop, the positioning data, the supply deficit reality, the ratio dynamics, the technical setup, are aligning in a way that historically has preceded major moves in silver. The last time we saw a similar convergence of these factors, silver made a move that caught most retail investors completely off guard. The people who were positioned ahead of time did extraordinarily well. The people who waited for confirmation, who wanted to be sure before buying, bought near the top of the move. That's the nature of silver. It gives you very little time to react when it decides to move. The question isn't whether silver will move significantly at some point. Given the structural realities we've discussed today, the monetary backdrop, the supply deficit, the industrial demand surge, the ratio dynamics, a major move is, in my view, a question of when, not if. The question is whether you're positioned before or after. Section 7. What smart money is watching? Here's what sophisticated investors are tracking right now that most retail investors are ignoring. Real interest rates. When inflation-adjusted interest rates are negative or near zero, holding physical silver, which pays no yield, has no opportunity cost. You're not giving up real returns to hold it. And when real rates are negative, hard assets have historically outperformed financial assets consistently. The dollar index. Silver is priced in dollars. When the dollar weakens, silver gets cheaper for every buyer outside the United States, which stimulates demand. Watch the dollar index carefully. A sustained breakdown in the dollar is historically one of the most reliable predecessors to a silver bull run. Central bank gold buying. Central banks around the world have been buying gold at historic rates. This is not a coincidence. These institutions have intelligence and analytical resources that dwarf anything available to retail investors. When the world's central banks are quietly accumulating gold, and when the policy environment suggests silver will follow, that is a signal worth paying attention to. Geopolitics. De-dollarization. The gradual movement of global trade and reserves away from dollar dependency is not a fringe theory anymore. The BRICS countries are actively building alternative financial infrastructure. Every step away from dollar dominance is a step toward asset classes that don't depend on any single government's credibility. Silver sits at the intersection of all of these trends. It benefits from monetary uncertainty, from industrial demand, from de-dollarization, and from the supply constraints that no amount of central bank policy can fix. Let me leave you with this. In the history of financial markets, the most significant opportunities are almost never obvious at the time. They look obvious in retrospect. They make sense on a spreadsheet. They align with every macro reality. But in the moment, before the move, they feel uncertain. They feel early. They feel like you might be wrong. That uncertainty is not a bug. It's the feature. If the opportunity were obvious, it would already be priced in. The silver story in mid-2026, the supply deficits, the monetary backdrop, the industrial demand supercycle, the ratio dynamics, the COMEX realities, is one of the most compelling structural cases I've seen in years. In the next few days, heading into and past June 18th, could be the moment when some of this potential energy finally converts into kinetic movement. I'm not telling you what to do. That's not financial advice, and nothing in this video should be taken as such. Always do your own research. Always understand your own risk tolerance. Consult with a qualified financial professional before making any investment decisions. What I am telling you is that the setup deserves your attention, the data deserves your analysis, and the next few days deserve to be watched closely. Because in silver, when the move finally comes, it tends not to wait for permission. So ask yourself one question before you close this video. When the move happens and the math says it's coming, will you be watching from the outside, wishing you had paid attention? Or will you be the one who understood the story before it was on the front page? The clock is ticking.